38% of Americans have less than $400 in savings. When the economy shifts, that gap becomes dangerous. The difference between riding out rough months and financial catastrophe often comes down to decisions made right now before pressure hits. Recession-proofing is not about predicting market crashes or timing perfect moves. It is about reducing vulnerability. During the 2008 financial crisis, people with 3 to 6 months of expenses saved had options. They could wait for better job offers instead of taking the first desperate opportunity. They avoided high-interest debt. The goal here is creating a financial cushion that buys time and choices when the economy contracts. This matters because recessions are not rare events. The U.S. has experienced one roughly every 6 years since World War II. The Federal Reserve found that 40% of adults could not cover a $500 emergency expense without borrowing or selling something. That $500 could be a car repair, a medical bill, or a broken appliance. When layoffs happen during recessions, that gap widens fast. Historically, unemployment benefits replace only about 47% of previous wages, and they take weeks to arrive. The first 7 days focus on knowing exactly where money goes. Many people discover they are spending $200 to $400 monthly on subscriptions they forgot about. Pull 3 months of bank and credit card statements. Categorize every expense: groceries, rent, utilities, insurance, entertainment, subscriptions, dining out. This is not about judgment. It is about data. One effective approach is dividing expenses into 3 buckets: essential and unchangeable, essential but flexible, and optional. That broken down view shows what can shift if income drops 30% tomorrow. A teacher in Ohio went through this process and found she was paying for 2 streaming services she had not used in 4 months, a gym membership she forgot after moving, and a software trial that converted to $60 annually. Total monthly waste, $83. Over 1 year, that is nearly $1,000. She redirected that amount into a high-yield savings account. 6 months later, when her school district announced budget cuts, she had built a small buffer that reduced immediate panic. Financial planners often suggest starting with $1,000 as a baseline emergency fund. Not 3 months of expenses yet, just $1,000. This covers most common emergencies without derailing everything. One option is opening a high-yield savings account separate from checking. As of late 2024, some accounts offer above 4% interest. Automate transfers. Even $50 per week gets to $1,000 in 20 weeks. Some people use windfalls like tax refunds or work bonuses. The key is separation. Money in checking gets spent. Money in a dedicated account labeled emergencies stays put. During the 2020 recession, the median unemployment duration hit 25 weeks. That is 6 months. Even in stronger economies, the average job search takes 3 to 5 months for professional roles. This is why the standard advice mentions 3 to 6 months of expenses saved. 1 month covers immediate shock. 3 months provides actual runway to find suitable work instead of panic accepting underemployment. Not all debt poses equal risk during downturns. Credit cards at 22% interest drain resources fast. Federal student loans offer hardship deferrals and income-driven plans. Car loans are secured, meaning missed payments lead to repossession. One approach is listing all debts with interest rates and minimum payments. High-interest unsecured debt gets priority attention. Some people consolidate multiple cards to lower rates. Others negotiate with creditors before missing payments. The worst move is ignoring debt when income is still flowing. That is when options exist. A software developer in Texas started freelancing 10 hours monthly, earning an extra $600. He banked all of it. When his company announced layoffs 8 months later, he was cut. That side income continued while he searched for full-time work, covering his reduced grocery and utility bills. It bought him 5 extra weeks to find a position matching his salary instead of taking a 30% pay cut out of desperation. Multiple income streams reduce single points of failure. The final week involves creating a reduced income budget. What if income dropped 40% tomorrow? Which expenses disappear immediately? Which get reduced? This is a mental exercise that removes panic from actual crisis. Many people discover they can temporarily cut dining out, entertainment subscriptions, and non-essential shopping, reducing monthly spending by 20 to 30%. Document this alternative budget. Save it. When financial stress hits, decision fatigue makes clear thinking hard. A pre-built plan provides a roadmap instead of scrambling in real time. 28 million Americans have no health insurance. During recessions, employer-sponsored coverage disappears with jobs. COBRA continuation costs an average of $700 monthly for individual coverage. Marketplace plans exist, but enrollment windows matter. Checking coverage options now, understanding costs, and knowing enrollment deadlines creates one less crisis point if employment changes. This is pure logistics, not fear-mongering. Financial resilience includes social capital. People who maintain professional networks find opportunities faster during downturns. This does not mean forced networking events. It means staying in touch with former colleagues, contributing to industry groups, and keeping a current resume. During 2008, studies showed 50 to 60% of jobs came through referrals and connections, not job boards. Reach out to 3 professional contacts monthly. Share useful information. Offer help. Strong networks function as early warning systems and opportunity pipelines when markets tighten. 30 days creates a foundation, not complete immunity. Week 1 audits spending and reveals waste. Week 2 starts the emergency fund with a realistic $1,000 target. Week 3 tackles high-interest debt before it compounds. Week 4 builds a recession budget as a reference tool. Add basic insurance checks and network maintenance. None of this guarantees perfect outcomes. Economic downturns still cause pain, but preparation transforms panic into process. When others freeze, prepared people execute existing plans. That difference matters enormously. Everything covered here is for educational purposes only. This is not financial advice. Every situation is different. Consider speaking with a licensed financial advisor before making any major money decisions.